Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissonneau, joined by my co-host Kevin Casey. And today we have Michael Simmons, but if we're lucky, we will also be joined by Jim Jenkins. We're not going to see him.
I'm here.
He
I
is
just got in.
Are you there?
Yep, I just got in. Thank you.
All right, great. Well, I will not be able to give you the same instruction I just gave Michael because we are now actually live. So welcome everyone. I hope you had an amazing Thanksgiving and that you are deep in your preparations for Kwanzaa, Hanukkah, Merry Christmas, Boxing Day, whatever does it for you. But I hope
New Year's.
amazing. New Year's. Okay, we're not quite there. As a
Oh,
matter
no, we are.
Kevin and I meant to have this conversation before now, but we have to decide whether we always take the week off. 1 week a year we take off between Christmas and New Year's. And this year, because Christmas Eve is on a Tuesday, I think it is a fool's errand to try and do this on Christmas Eve. I think 2 people show up, Kevin and I, and maybe not even Kevin. So I don't know. We'll see. We'll keep you guys posted. Okay, but with all that being said, don't forget in the middle of all this loveliness that we have to renew our NMLS. Michael, have you done yours? We know you did your continuing ed.
Yeah, he did. He was checking in with me on it.
Yeah, I did, although I haven't seen it clear, and maybe that's because I haven't paid the fee yet.
You think that could be it, Michael? They're not going to give you bupkis unless you give them all the money.
It's that famous Steve Martin line, I forgot.
Okay, I don't know how you forget to give them the money. That is the most important thing for them. With all that being said, don't forget, kids, because it is taking, it sounds like a little longer than normal. And Kevin, yeah, we know Kevin.
Yes.
So Kevin has told us ad nauseum that it took him forever. I keep telling him that it's because they have to do double checking on him. And also it might have been longer because a lot of people did it on the same day you did. And so I would think that it trickles out a little bit. Oh, you don't know. You're making this up as we go, Kevin. Anyway,
yes, of course.
That being said, we don't know how long California is taking because Kevin's litmus test of 3 weeks doesn't count because he did his on the opening day. So with all that being said, don't forget, and yes, Jill, armed robbery is a problem if you're trying to renew your NMLS. So the other thing that I want
No, only if someone was hurt and money was stolen.
Okay.
If you didn't actually steal the money and you only pistol whipped the person, you can keep your license.
Okay, someone was hurt if you pistol whipped them, okay?
No. You can hurt people. You just can't take their money.
God, this is ridiculous.
As long as no money was lost, you cannot lose your license.
Oh my
Yeah,
God.
no, it's true.
Okay, stop it. Please do not take legal advice from Kevin. He talks out of his orifices on occasion, and just want to make sure that you are not planning your the funding of your Christmas presents.
The CFPB told me this.
Okay, stop it. All right, with all that being said, business plans, kids, you should be all over it and deep into implementing it now. And I mean, like working on it. Do not start. I think this whole thing where, on January 1st, I'm going to start this. First of all, let's keep it real. Nobody starts crap on January 1st. Everyone's still hungover and dealing with taking down their Christmas decorations. It's January 2nd at the very least, or best. So with all that being said,
don't be calling me on January 1st.
What?
Don't be calling me on January 1st.
Talk about hungover. Okay, so speaking of the CFPB, which Kevin just did, but this is more valid than what the hell he just said. The CFPB, believe it or not, has proposed a rule to rein in sprawling, this is a quote, sprawling data broker industry. So what that means is if the trigger lead bill does not happen, which let's give it optimistically 20%. Okay. 20% chance of getting through.
Are you saying, because I heard this morning and I thought I was sleep over. I heard it as the radio was coming in and I woke up and I heard this, what you're saying about that. I think you're about to say, but then I looked through all the news and I could not find it anywhere.
Clearly you didn't read Chrisman this morning because Rob Chrisman is where I got this. So, and then I reached out to my buddy at the CFPB to confirm that it wasn't a bunch of baloney, and it is not. And here's the best part.
because we told them to do this.
Well, we've been on his tail up for a very long time for about this for sure, and a myriad of other things. And so I'm sure it was just us, Kevin. Nobody else has mentioned this to him ever.
No, I'm pretty sure it was just us.
Yeah, right. Anyway, bottom line is the CFPB is proposing a rule to rein in the sale of all of our private information, which would be delightful. And here's the other thing too, because we had the CFPB with us a few weeks ago, and we were talking about what the odds are of getting anything through, as Rohit Chopra is winding down his time at the CFPB and a new administration is coming in, blah, blah, blah. Like, what were the odds? So here's the thing. It is very possible that this will be taken up by the next administration also, which is so great to hear. Oh my God. Anyway, so with all that, yeah, can you believe it?
So trigger leads, so tell me more about what they're proposing.
Well, it's not just trigger leads, it's not just mortgages. They're trying to limit the ability of people to broker our private information, which is a huge industry. Huge.
Because I've never understood how they're able to do this, because we can't do this.
Okay.
It's against the law for you and me to sell the fact that the Joneses are getting a mortgage.
Listen, what they don't know won't hurt them. Just kidding. Okay. So I'm just going to read directly from this so I am not misquoting or misrepresenting anything. In today's economy, personal information about this is from the CFPB, by the way, about consumers is frequently revealed and collected during routine activities like ordering products online, to downloading apps, swiping credit cards, or stores. At stores, not or stores. A growing industry of data brokers has emerged to collect and sell a wide range of information about consumers, often without their consent. Ding, ding, ding. The CFPB's proposed rule would help ensure that data brokers comply with the Fair Credit Reporting Act, a major federal privacy law. Can you imagine such a thing? The rule would strengthen accountability for data brokers, making sure that certain financial data, like the consumer's income, is only shared for legitimate purposes, and restricting credit bureaus from selling people sensitive information like social security numbers and phone numbers. So what I want to know really is, and I'll take this up with them, trust me. Remember when we were told that there was a company that was analyzing their borrowers' spending habits,
Yes.
and they had figured out that if somebody used their credit card to buy fast food chicken at 3 p.m. on Tuesdays, they specifically were more likely to default on their debt.
Well, how about the guys who are selling the fact that they subscribe to certain magazines that triggered leads?
Yes. Magazine sales. So I God, remember that? That was so funny. I was like, okay, listen. So if you think that because I subscribe to, like, Ladies Home Journal, I'm one thing, and Sports Illustrated, I'm another, and Babies Are Us, or whatever the baby things are, parenting, there we go. I had suggested that we should subscribe to Penthouse Letters, some sort of Hustler, something or another, and then some baby magazines and sports magazines, and just
to mess them up. Yeah. Because I bet they're also selling like your subscriptions for your like Netflix and like Peacock and all those other streaming services. I bet that information is sold.
I wonder if this will restrict that too, because again, they're doing this all to figure out what the heck we like. And the fact that we're being watched 24/7 should bother more of us than it does. So anyway, with all that being said,
I don't think I'm going to hit I like a movie or TV show anymore after I watch
they took that off as an option on Netflix. I think, don't quote me on that. Anyway, bottom line is, so Art Cashin, who just died, he was a Wall Street icon, and he, as a Wall Street icon, paid cash for everything. He wouldn't use credit cards. Didn't have a cell phone. He had a flip phone. He never answered it. I was reading all about him this morning. And, but yeah, this Wall Street guy would not use credit cards because he knows that they're tracking us. So he used cash 100% of the time for anything he could. I keep saying this, analog and cash, people, we need to go backwards on some of this stuff so that we're not.
Or use somebody else's credit card. That's a much better way of doing it.
Oh God.
You don't even have to tell them.
Okay. All right. That's enough. Okay. So, jeez Louise. Okay. Have you been drinking this morning? That's what I want. No. Okay. Good God. Okay. So there's a lot of economic stuff to talk about today, but I'd like to get to our appraisal conversation sooner rather than later. So we'll circle back to some of the economy, things about the economy. So Michael and, the invisible Jim, we invited you here today because there are some things going on in appraisals. We know this because Kevin and I, when teaching NMLS, have discussed the new air requirements and new ROV requirements. And then we had somebody scaring the crap out of us, making us think we could never talk to our clients about this anymore. And you have, thank God, informed me that is not the case. So let's start with air. What happened?
Wait, what is air other than the stuff we breathe?
Okay, did I mention he teaches this stuff, Michael? All right, thank God I'm there. Michael,
Oh,
what's wrong with us today?
I don't know. I don't know. I didn't realize when I woke up that I drew the short straw today. You guys are hysterical. Air is about appraisal, and air is about appraisal independence. And I'm not sure that there's anything new about air.
Yes, there is. The data collectors have been added to the people being protected. And
Oh,
And
we are, Michael, geez Louise, thank God I showed up today. We are now, because we are LOs, we are now restricted. And then the people who
Restricted parties.
restricted parties. Oh,
Yeah.
now you know something, huh, Kevin? So anyway, the people who like us, because we're the bad guys, we're restricted because when I was a kid, I was never grounded. I was put on restrictions. So I have triggers from this, which nobody seems to care about, but fine. Anyway, so we're now restricted parties and we're not allowed to do any of the things that we also couldn't do to appraisers. And then the appraisers and you and all the good guys on the other side of this are now independent parties. Is that right? Okay, there you go. So tell us the rest, please.
so Jim, you were going to add something. By the way, Jim Jenkins is Axis chief appraiser, and I asked him to be on the call this morning so he could answer any kind of arcane, complex appraisal questions. Frankly, I'm just going to hand him the ball.
Okay, so you're going to sit there and look pretty, and then everyone who's listening is going to sit there and dream up some arcane, crazy question to ask Jim. All right, so
But Mike, if you just
There we
move your
go.
lips while Jim is talking, everyone will think it's you who are talking and you'll look important.
That's helpful. Should I do it in a British accent?
Yeah.
always 100% of the time, please. Okay, Jim, sorry.
Hey, Jim.
That's all right.
Usually
So
like
I
that.
live in Arizona, first of all, and you can't go out to eat without, or you can't go out to eat at a restaurant and pay cash. It's transitioned predominantly to credit or debit card only. So
That's
anyway,
that's against the law in the United States.
We need to push back from that because
Yeah.
it is, again, this is, yeah, it's driving up costs.
It's against federal law not to accept legal tender.
yeah, it's posted everywhere. So
Ooh, you tell him, Jim. Tell him Kevin
United State of Arizona. So yeah, the appraiser independence requirements in relation to property data collectors is kind of a misnomer because the two don't. PDCs, property data collectors, aren't appraisers. So when Mike and I were a little stumped about the update for air requirements, that's probably why. Now that you say property data collectors, there's some requirements that third-party companies that utilize property data collectors have to make sure that they, or employ property data collectors, have to make sure that they are properly and equipped, properly trained and equipped to do the task at hand, and also undergo a background check. So that's really the updates that I'm aware of.
Well, I think,
Mike.
first of all, just for anyone who is not aware that it is now acceptable for someone other than the appraiser to go into your client's home and do everything the appraiser used to do. And so from our end, we do have, so, I mean, who are these people? Do we know them? Have they been vetted? So it's good to know that they at least have to have a background check, how tested are they on doing measurements, et cetera, et cetera. But again, we are not allowed to interact with them, bully them, and influence them. I mean, can you imagine going to some data collector and be like, listen, you give me another 10 square feet or it's toast for you. Anyway,
Exactly.
but the bottom line is they are protected just like appraisers have been for all these years. And so make sure that you are behaving accordingly, people.
But
And
they
your
don't have a
client-
license.
What?
They do not have a license, though.
No, the
Yeah.
license is not required.
Not yet.
Not yet. Correct.
So
What is
what is the
Who is
cap-
typically employed as a property data collector? They're home inspectors, they're appraisers, believe it or not. They're real estate agents and anyone else that's semi-qualified and familiar with real estate that can pass a knowledgeable and reasonable test, if you will, or evaluation of their abilities.
so?
how much are these guys making now? Because I know, appraisers used to make, the appraisal fee, but
Well, let's be clear here. There is a distinct difference between a property data collector and an appraiser.
yeah.
The property data collector will never opine about a value. That's not part of what they do. Appraisers have historically done inspections where they observed and reported. The property data collectors are held to a little more detail in terms of the amount of reporting that they have to do. They're trained to measure properties just like an appraiser is trained to measure properties. They have to pass a criminal background check, but at no time do they have anything to do with formulating any opinion of value whatsoever. And that's a really important distinction. Fannie and Freddie employ them as your value acceptance, part of a waiver process when they want to get additional data on the subject property as part of a waiver. You're seeing them now popularly matched with AVMs in getting HELOCs, because their HELOCs are basically a credit decision anyway. The idea that they're going to create a value, accept a collateral value by an automated value model plus what amounts to a property data condition report really tells you that you're looking at a value range when you're looking at an AVM, and you're really looking at just a condition report of the property. But the decisions are on HELOCs are basically credit decisions that are being made. That's why they're being permitted.
So when we talk to our clients, it may not be an appraiser who comes to their place. It may be a property data collector.
In all likelihood, it won't be an appraiser if they're just doing a property data collection. It's unusual at this juncture to have appraisers doing property data collection. They just don't want to do them.
Wow.
It's outside the spectrum of what they normally do. So,
Well, I think
Yeah,
it's
and
on they were being accused of all sorts of bigotry and bias, et cetera. And so this is supposed to put an independent person in there who can go in there, take some measurements, make sure they get some photos that don't include the family, and have it be hopefully a little more objective. Is that the purpose of all this?
yes.
the purpose actually isn't to be cheaper or faster. It's to cater to situations that don't really need a full-blown appraisal. It's to cater to situations of rural properties where, let's face it, driving the comps and measuring the property and taking pictures, that's the easy part. The hard part's back at the desk doing the analysis. So in rural markets, if an appraiser has to, drive 100 miles because he's the only one in the area, that's 200 miles round trip for, an hour hours worth of work that can be done by a third-party property data collector, and then they can just deliver that information back to the appraiser, and he can sit at his desk and do the rest of the 4 to 6 hours and writing the appraisal up and doing the analysis. So it alleviates that windshield time for the appraiser to do, work that someone that's minimally qualified can do.
So first of all, just,
Fannie Mae,
oh, go ahead.
Fannie Mae is the first to recognize when it comes to GSE appraisals and property data collectors that it's not necessarily or at all, it's not the goal to be cheaper and quicker.
Jimmy, we
There
never expect to be cheaper or quicker anymore. We're over it. We know that whatever they're employing, it's gonna be longer, more of a pain in the wazooski, but whatever. So,
Right.
so is this really working? Is it making it so are the appraisals better with this system?
I don't know that they're better. I don't know that they're any less reliable. It's not really fully employed or accepted. And, keep in mind, in a down market, we talk about quicker. In a down market like, we are right now, where there's not a whole lot of volume, there's a lot of appraisers that are, willing to drive 100 miles each way to do the appraisal. So in a market such as we're in right now, there's not much of a need. I suspect when the market picks up and there's a quote unquote shortage of appraisers again, that it'll be more popular and widely accepted.
How are we doing on the appraisal population? Because we're starting to see turn times at certain lenders really grow. Because people did cut back and they haven't brought people back to fill the volume that's increased. So are we seeing any of that? Is it regional? Is it, tell us about that, because God knows none of us want to go back to 2020 or 2021.
Yeah, I think there's a little bit of regional aspect to that. There's also, quite a few appraisers that made a lot of money in this last up cycle, and when they retired, 15 years ago, now they had to come out of retirement. Now they have more of an opportunity to retire. So there is an exodus. The main issue is there isn't incoming appraisers to replace those appraisers. So,
but there is these property inspectors or independent data collectors that could, in theory, become appraisers. Am I correct?
Correct.
It's kind of a stepping stone.
What is the process?
Yeah, and when
is it easier? It is easier than it used to be, but how long does it take? Like, what are the requirements quickly?
I don't know that it's easier. The education requirements have been lifted to where you don't have the requirement of a 4-year degree, which is any degree. It could be, sports medicine, it could be agriculture, whatever. It doesn't matter, just a degree, which makes no sense whatsoever.
Right.
Some of the best appraisers that I know don't have even a 2-year degree. So it's still there's still a lot of hurdles, a lot of time involved. The hours have been decreased a little bit. It depends on the state. But the biggest obstacle is the acceptance right out of the gate. So if you fulfill all the requirements, getting accepted on someone's panel to do work for certain lenders that have requirements that you have to have been an appraiser or licensed appraiser for 5 or 10 years.
Oh, wow.
That's one of the biggest hurdles.
Wouldn't
And
that
it
be
really isn't.
on the mortgage side, if you could only hire someone who has some experience, who's been in the business for a while, knew what the hell they were doing versus, anybody who decides that it's a part-time gig and they can just make a lot of money could get in. I appreciate having some sort of barrier of entry. I know it's too much on the appraiser side, but where's the happy medium, right?
Right. My wife and I joke that we go to concerts and we stay away from the low price point ones because that's where all the riffraff occurs. So if you pay a little bit more, it's a little bit more enjoyable because there's less riffraff. But,
Yeah, but they also get boring.
yeah, well,
I went to one of those
it-
concerts, and the band couldn't get the audiences, stand up for the songs. And it's like, it was driving them crazy. It's like, God, you guys are like falling asleep out there.
that's what happens with Page.
And I go to the symphony, nobody's standing up until they're applauding it.
They don't rush the stage at the symphony. Come on.
No indication of somebody's interest or involvement, so come on. Okay, so yeah, so we're not the only industry that's having this problem. We have a smaller population and people want to sit behind a computer and earn a lot of money, and so they're less inclined to do something like, be an appraiser. I mean, electricians are having that problem too, and that is you can charge a lot of money and make a ton of money doing that. So
Better yet, plumbers.
anything that you can't replace with a computer is highly desirable as far as income possibilities. So yeah, I don't know. I mean, but again, they keep pushing AVMs, and I have never gotten an answer that satisfies me. I've gotten answers about how does an AVM understand a view and its value, or I know we're not supposed to think about neighborhoods anymore, but anyway, it's a little more complicated than can be solved by not everything can be solved by a computer. That's my point.
So
You're
Audrey,
correct.
the truth is that automated value model reports were designed to help investors gauge the risk of the collateral that they were purchasing. That's really what they are. They're risk instruments. They're not specific. They speak to a range of values based upon a certain series of algorithms. If you notice, not all AVMs will agree. That's why a lot of lenders use what they call a cascade, where they'll have 2 or 4. I know Wells Fargo at one time was using 11 different AVMs to give them a cascade, so they had a cross section of all the different analytical perspectives on a particular property when they wanted to do a really deep dive and make sure that they were covering. And not all AVMs are strong in all regions. There's some that are better in certain regions for certain types of properties. So there's not really one size that fits all. They're tools. They're simply tools. And that's why they're employed to provide kind of a collateral risk perspective for HELOCs. It's one of the reasons why they are not permitted, or in a traditional sense, for the extension of standard lending, because they're not precise enough. They're not specific enough.
Wait. We use them in standard lending all the time. Right?
What do you mean? What do you mean?
They're using, okay, maybe you don't.
You mean waivers?
The waivers, like, how is that not standard?
Well, first of all, do you get a copy of an AVM when you get a waiver? No, you don't, do you? So how do you know what they're using?
God,
I mean, if you ask Fannie and Freddie, they actually would tell you, well, we don't really use an AVM. We have a series of things that we do that help us better calculate what a price range would, a reasonable price range would be. I mean, that's basically what the answer is. They all use AVMs. That's exactly what they use, but you're not going to get a copy of it because it's not defensible. Waivers are a byproduct, and if you saw Rob's column, I guess it was a week or so ago, when he had asked me to answer a question from one of his readers, waivers are the product of 4 different categories of analysis: credit, income, assets, and finally collateral. And the collateral piece is typically either a condition report like you would get from a property data collection, or simply from an automated value model. So it's combination of all of those that goes into the decision about what's the risk that this particular borrower might default, right? And if somebody gets a waiver, they don't get an appraisal. They don't get any opinion of value. In fact, they don't say anything about that. They just say, we'll make the loan to you. We've judged that the loan is within the reasonable range of risk for us to advance those funds. And if the borrower says, well, wait a minute, that's great, but I'm putting down my money. Is it reasonable for me to put down this money because the property is worth that much? And the answer is, we're making this to support the loan that we're advancing to you because we believe it's a reasonable risk. So take that for what it's worth.
So
right?
you were the person that brought this to our attention a couple of years ago, where a lot of us were under the impression initially that a waiver meant that they had blessed the value, that Fannie Freddie were saying, yes, the value's fine, and that was some sort of endorsement of whatever the purchase price was or what we thought the value was. And then you were the one who told us what you just said now, which is it is a combination of things. It's the risk factors going into the loan file that determine whether or not this property is eligible for a waiver. And that is such an important distinction. So if you have somebody who is thinking, hey, I'm going to buy this house, but I might be transferred in a year, you might want to get an appraisal, even if you did get the waiver, just to make sure that if they don't put down a ton of money and they have to, get out of Dodge sooner rather than later,
They get their money back.
they don't get stuck with a property that's worth less than they thought it was when they were going into the purchase. Is that fair?
So, yes. So one of your listeners, Peter, just asked, so value acceptance isn't an opinion of value. That's exactly correct. And I'll say one more thing. The GSEs are very precise in the language that they use. When they say value acceptance, that means that they're accepting the value that was given by the real estate agent, if it was a purchase, by the purchase contract, if it was a refinance, by somebody's estimate of value, whether that was based on need or some mystic assessment. That's exactly what it is. So in effect, if you're buying a house and you're paying $600,000 for that house, and Fannie or Freddie issue a waiver to you, then the new comparable sale will show that sale was $600,000. Now, I will tell you that we've seen waivers issued and then found out later that some broker had also ordered an appraisal and it came in below what the waiver price was because they were hoping it would be higher. Well, they just didn't submit the appraisal. They forget that it goes through UCDP, and eventually the GSEs match all those dates and addresses, and then they send those little notes that said, well, your waiver was rescinded because you violated the terms, you got an appraisal when you weren't supposed to, and so here's the invoice for the underlying mortgage.
Whoa.
Yeah. Okay, so
Freaking minute. That's a monster.
you get an appraisal value, but your client still wants to do an appraisal to be sure of value. It comes in below purchase price, and now you have to buy back the appraisal or the loan. Wow.
Yeah, you can get an appraisal after everything's all said and done, after you're in the house. But while you're under the if you are paying attention, the waiver process says that you can't get an appraisal in this process. It voids the waiver. It voids the waiver for this very reason, right?
This stuff, Michael. You know what? If I had slapped you a little bit, you wouldn't have told us today. Come on, we need to know these things. Good God. Oh,
well, that doesn't mean a borrower can't do their own.
Yeah. Go ahead.
that doesn't mean a borrower can't do their own due diligence and hire an independent appraiser to do an appraisal and
Just not date
you
it.
know, just for their peace of mind.
On
It
the other-
doesn't have to be submitted with the loan package or
Right.
submitted to anybody. It could be just solely the due diligence of the borrower.
Okay, so if they do their own, the borrower does an appraisal and it's not on the usual R
But-
form.
And all borrowers have their own database of appraisers that they can just reach out to. We all know that. So
Well, look, it's a lender condition. Jim's correct. It's a lender condition. Lenders can't do that because it voids the waiver,
okay,
right?
That's
That's what it does. It voids the waiver. And we've seen them where 6 months later, the broker received a notice saying, I remember the case, it was in Washington, where the value was 140,000 less than what the waiver had approved the transaction for. And they asked us to do an appraisal, a retrospective appraisal. And we said, well, the retrospective appraisal will show the same thing that the original appraisal showed, because we didn't know there was a waiver. Nobody told us there was a waiver. They took the waiver because it was a better deal for them, right?
yeah.
So I understand it, but that's not our problem. We would never have known it. And I said, you're not going to get that value because it doesn't exist. And in fact, the property's not worth that amount of money now. So they had to write a check for the difference when they paid off the loan. Huh?
What about the borrower in that situation?
So the borrower was guiltless in all of that.
Right, got that.
Because this was all driven by the lender. So the lender now has an obligation to replace the terms of the loan. And of course, interest rates were higher. So that was like a double whammy.
Right.
So the interest rate was higher. They had to replace the terms of the loan to match the original underlying loan that they got, and duration as well.
Right.
So it was not a very gentle piece, and it cost somebody some real money.
Yeah, real money.
Real money, 6 figures. So,
Sure.
and it happens. It happens. It's not common, but it happens often enough that it's troublesome.
Okay, I don't want to beat this to death, but did the borrower know that they were buying a place that was completely overinflated in value? And if so,
So I would submit that that's part and parcel part of the problem, because we have, our world is one where we look for instant solutions, right? How can I get the house that I want? Oh, I have good credit, I have good assets, I've got good income, and I'm told that they'll make the loan to me based on the purchase price that the seller wants, and we're happy to pay that because we haven't been able to capture a property, and so we're happy to pay that. And they forget that doesn't confirm or support what the purchase contract might say, at least not from an appraiser standpoint, right?
right,
So if they go to sell that house 6 months later and nothing's changed, or a year later and nothing's changed in the market, they not only have the additional new sales costs, but maybe the value wasn't there in the first place and they're upside down.
Wow.
So would they have made the same decision? I don't know, but I know I would want it.
well, I know as an LO that I do have these conversations because of you from a few years ago with my borrowers who get waivers, and I just say, listen, it's not them stamping the value. It just says you don't need to, to have an appraisal doesn't mean that the value that you're paying is correct. So it's just
and that's one of the reasons why too, I think you find that a significant portion, although I think it's less now than what it used to be, but a significant portion still of borrowers don't accept the waiver when it's offered.
oh,
And-
What is a significant number? 4?
At one time, it was about 50%. I think it's less than that now. I think it's less than that.
50% don't take it.
Yeah. That's what it was. That's what it was originally. I think close to 50%. But I'll tell you, when the GSEs tout the fact that they've saved billions and billions of dollars for borrowers over the last X number of years in appraisal fees, you know,
They can take a hit once in a while.
well, yeah. And that's also a reflection of the fact that we were in a bull market for a long, long time. And time was everybody's friend, right?
Yep.
As property values kept increasing. In fact, they're still increasing, even in light of the fact that rates have gone up.
Yep.
Yeah.
Yeah. Well, I've never had somebody decline a waiver ever, like ever.
Yeah, I've never had one either.
That's interesting. Very. Okay, we have another question here. And I'm not sure, it's in the chat, so you can see if you can figure out exactly, because it says, why are appraisers just putting $500, I assume that's $100, for land and not checking this affects the insurance on the loan? There's no way the Bay Area you're going to see land over 13,000 square feet for just $500. Yeah, I have a lot of issues with some of the numbers they use for, like bedroom count. Holy crap, like it's like this minimal amount for one extra bedroom, but borrowers won't buy a 2-bedroom when they need a 3-bedroom. So it's got to be more than that. Makes no sense to me. So explain yourselves, Jim and Michael.
Bathrooms are king and queen. The more bathrooms historically, the more value are attributed to the home. Same with bedrooms in certain scenarios. When you go from a 2-bedroom to a 3-bedroom, a 3-bedroom is generally worth more.
Yep.
When you go to a 3-bedroom to a 4-bedroom, that increase diminishes, that the return diminishes, because not everybody needs
So
4
an
bedrooms.
11-bedroom is not that much more valuable?
No, Jim,
Correct.
only for someone who needs 4 bedrooms, it's worth more. Come on.
But the portion of the buying public is smaller that has those demands.
Yeah.
It's your buying public that's doing that. Right? And it's
Now,
square
has that
footage.
changed over the last 4 years? Yes, because of work at home. There's a 4th bedroom when you have no kids. You got 2 extra. You've got a guest bedroom and 2 offices or whatever, a workout room and an office. So, things change, and when you see those changing adjustments, that's why. It varies from market to market. Land is, you're right. You can't buy anything for under $500,000. So when you see a $500 adjustment for the differences in site size, it doesn't quite make sense. But that adjustment in the grid made for the differences is what the market, it's called contributory value, and what the market is recognizing that difference might be.
Okay.
There's a bigger push. There's a bigger push to actually support those adjustments right now. It's one of the hottest topics in the appraisal business, and appraisers are getting a lot of pushback, not from lenders necessarily, but from investors, FHA, and the GSEs.
Well,
you say the difference is this. Well, show your work.
Jim, the lenders aren't pushing back because we're not allowed to talk to appraisers. If we were allowed to talk to you people, we would definitely be pushing back.
Yeah. Which brings us to ROVs.
So, first of all,
yes, Michael.
Real estate agents talk to appraisers all the time, and it's a matter of what you say that counts, not so much that you say something. Your lenders don't want you as brokers to speak to appraisers because there's jeopardy involved. Right? You get into the he said, she said, they said, and there's a concern. So there's a process to be followed, and Jim's great to point it out. The reconsideration of value process. If you have questions about that, you can formulate those questions in a formal process. We will filter them We'll help make sure that everybody asks the appropriate questions in the appropriate way and get you what is the appropriate answer. All appraisers should treat reconsideration of value requests as an opportunity to help the lender and the client understand better how they arrived at that value, so that they feel comfortable and confident about it. It's just one of the burdens that appraisers have. The new ROV process is frankly pretty much the same as the old ROV process. I think mostly what we did is we put a section for the borrower to sign that they were requesting this, but almost everything else I think on our ROV stayed the same.
ROV being reconsideration of value?
Yes, that's right.
Kevin, look at you getting that one right. I'm so proud of you. Yeah, so when they first, when we first read about this new ROV process, it made it seem like we couldn't even discuss it with the borrower. The borrower had to drive the whole thing. We weren't allowed to participate. Like sounded like a nightmare.
Well, I talked to somebody about how we were restricted parties. They weren't in the mortgage world at all. And they're like, well, our whips and chains involved in this restricted party thing. I had never thought of it that way, but somebody did. I think the same people came up with the restricted party category as the same ones that came up with the LIP and the VLIP.
Oh God! Oh God! Don't even go there. Anyway, bottom line is the ROV. So the borrower, and what I didn't understand, and again, you helped me understand, was that there were lenders and realtors out there who were driving ROV reconsideration of values for the borrowers, and the borrowers, it wasn't in the borrower's best interest necessarily. And so they wanted to keep their deal together and have the value be higher so that their deal was fine. And they didn't have to, go negotiate with a seller. And that is what this is going to help with, is make sure that the borrowers really do understand what's happening, really do want the ROV to happen. Do they want the value to go up? Some of them do. They do. They don't want to have to bridge that gap. They're buying the house anyway. That is the market. It is what it is. So in those cases, they're going to participate and help, especially. And then there's also the refis, where I've done them on refis and had great success also. So this is to stop the self-serving LOs and realtors and anyone else who might have done ROVs in the past or wanted them without it being good for your clients. So it's a good thing from what I could tell at this point. Yeah.
Yeah, definitely. It promotes consistency and transparency. I don't know how many times I can tell you that, when we receive ROVs, we don't really know where they're coming from. They're certainly not coming from the underwriter. We receive them either uploaded through the order platform or, through email. We don't know where it's originating from, and oftentimes it was a listing agent. Well, but without the borrower's knowledge. So now this just wraps the borrower in. The borrower and co-borrowers all have to approve the ROV. Then it gets sent to the underwriter, and they have to go through their own approval process and screen it and approve it and send it to the appraiser, or in our case, send it to us, and then we screen it again. So it sounds like a lot, but it just, the amount of transparency and the borrower's willingness, acknowledgement, and approval to submit an ROV on their behalf.
So we don't work just through the AMC. We have to go get the underwriter to approve it?
Someone, a designated person through
right.
At the lender. Yeah.
All right, moving right along. That sounds great.
Is there a tracking of appraisers who have to have their loans or the values reconsidered? Because it seems to me that there's some appraisers that are just notorious for coming in with bad values.
That's usually market driven, not to be defensive of appraisers, but that's usually market driven, because it's not in an appraiser's best interest to. I don't want to say come in low, because it's that's not a low appraisal.
This is just something I've noticed about appraisers. Maybe I'm wrong, but I've noticed that if the client reschedules an appraisal inspection, that is often a trigger for a low value coming in. And I don't mean like a significantly low value, but like a $4,000 shy of what the purchase price is kind of thing, where it's kind of the appraiser's opportunity to stick it to the
Yeah.
person, just screw them
I've-
out of this 2 inspections for the day.
Well, I would hope not. I would
I-
hope that would not be the
Happened
case.
not too long ago where
Yeah,
I know that happened because between the tenants and the property manager, all this stuff, that, I mean, in the appraiser's defense, it was a pain in the wazooski. However, yeah, we definitely got punished on that
I
one.
mean,
Okay,
I tell my clients, do not under any circumstances reschedule, or if the appraiser says he can be there at Wednesday at 2, you move every appointment you have so you can be there Wednesday at 2.
God. Okay, we're gonna run out of time. I want to get through some of the economic stuff that's going on. First of all, kids, it's jobs week. And I have one other thing I want to get back to you guys, I hope, with before the end of this, Michael and Jim. So just hang in there.
Don't fall asleep.
Yeah. Hey, you know what? You should know this too. Okay, so Wednesday, that's tomorrow. We have ADP coming out. Thursday, we have initial jobless claims, and Friday we have BLS. So BLS, if you recall, last month had an abnormally small number, 12,000 job creations. And so they're expecting that number to be substantially higher this month. It'll be interesting to see how it ends up because they have been all over the place. And you know how everyone
So
on
if
this,
jobs or numbers come in higher,
What?
that would, if the jobs, you're saying jobs, there'll be more jobs when you say.
remember what the latest estimate is on the one a couple of days ago was they were expecting $195,000, not dollars, jobs created this month or last month. And I think I saw something this morning that was a little higher than that. So we'll see where it ends up.
So that would push rates up.
It
If
just,
rates,
you never know. You just never know what the market's gonna do. It's ridiculous.
so you know what, I'm just gonna walk.
We also have Mortgage App's Powell's speech this week. We've got the beige book, the Fed's beige book, which, last month painted a much less rosy picture of the economy than we're seeing in some of these other reports. So that'll be interesting. I thought it was very interesting also to note that to be counted as somebody who's actively looking for a job, you have to have either put in an application or had an interview. So the fact that you're looking, you don't see anything that you're applying for and you're out of work, that's not the litmus test. The litmus test is, did you place an application? Did you have an interview? I just think that's incredible. So anyway, so that's on Friday. So it's, again, another barn burner of a week potentially. So just watch it. CoreLogic home price index came out. It's flat month over month, but higher than the 1/10 decrease that they expected. This is a normal flattening for this time of the year, and year over year, according to CoreLogic, we're up 3.4%. So that's, it's positive from my perspective. New rents are down 0.8 in November, 0.6 year over year, which has still not trickled into those inflation numbers the way they should, in my opinion. We got PCE, personal consumption expenditure, for October. It was up, but totally in line with expectations because remember, we are replacing extremely low numbers from last year at this time. So it is making these numbers seem a little higher than they would otherwise. It is not until January that those numbers, that we had higher numbers last year. So we've got a little ways to go, a couple months more of things not looking like we're making great gains on the inflation front, but the Fed is really, really watching it. Jobless claims were down 2,000 to 213,000. That's initial, but the continuing claims are at a 3-year high at 1.91 million, 191 million. That'd be bad. Anyway, so it is pending home sales were up 2% month over month, 5.4% year over year. Third straight month of increase. So that's positive. So there's a lot going on out there. And, again, we keep just really promoting that you have more to lose than to gain, so really be careful with your clients and locking and making sure that you are keeping your eye on the ball and not, buying into I hope it gets so much better and it's going to be better. And, maybe, but in the meantime, people need a place to live and they need to get it done. So And then finally, I thought it was interesting because the Mortgage Bankers Association had come out with their estimates at their annual conference not too long ago. And they had said that they expected our volume in 2025 to be $2.3 trillion in mortgage origination. So this year we're on pace to do about $1.79 trillion. And I had pointed out at that time that last year, the Mortgage Bankers Association,
They projected us to be like 2.5 something, right?
not 2.5, but it was higher definitely than the 1.79 trillion that we ended up with. Well, just a little update. They just reduced their forecast for 2025 from 2.3 trillion to 2.1 trillion. And so that happened within a matter of weeks. So
That's just because you called them.
I did not call anyone. Okay. It is not my fault. So bottom line is there is, everybody.
Maybe you should have called them, Audrey.
God, okay. I will. But the bottom line is that there is expectation from everybody that I listen to and have been hearing from that we will have a better year in 2025, but you're going to have to make it better. You, not the market, not the rates, you. You're going to have to get off your tail and you're going to have to do some things that are different and probably a little uncomfortable. So if you have run your business dealing with thinking, oh, I'm just going to get an email with a referral or it's just going to fall out of the sky, you need to retire because that is not our market anymore. It is definitely, we are working it. Kevin and I are both doing new and different things. And some of it is old school stuff. And we need to drag the young ones into it too, because that old school stuff works. So with all that being said, I'm excited because 2024 for me has been way better than 2023. And I know that 2025 is going to be way better than 2024. And it is because I am doing things different. I'm doing different loans. I'm thinking differently. I'm not obsessed with where the rates are. I care. I want people to have good rates too. But you have to deal with what our market is and not be obsessed with what you wish it would be and what somebody else wishes it would be. And another thing I did the other day, which I wasn't sure how that was going to work out. I got a referral from a realtor and I had a nice conversation with a guy. They're doing a special kind of transaction. And in the middle of it, I realized that there was something that they should be doing that they weren't doing. So I mentioned that. He's like very appreciative and sounds like he's very happy and everything is going swimmingly. And, we get to the end of the call and he goes, oh, and by the way, I'm going to go apply with my credit union. And he goes, just want to make sure that you know and that that's fine. And I said, actually, it's totally fine, but I don't work with people who are working with other lenders. And so feel free to knock yourself out. I would be willing to guess your credit union would not have just given you that little tidbit that I gave you that will probably save you a lot of money. And, but do what you need to do. I'm fine either way. And so days go, the weekend ends. Last night, he sent all his stuff, filled out all his application. I got everything. I'm like, holy crap. I was willing to let that go because I'm not going to do a ton of work for somebody who isn't as committed to me as I am to them. I value myself. I value.
Love that.
Know that I bring something else to the table that many other LOs do not. So value yourself, make yourself an asset. Why are you different than pushing a button? So that's something, in my opinion, that's important going into this next year. Any last thoughts, guys? What are your?
I thought you had a question for Michael.
Well, I would just say that don't take Kevin's advice and pistol whip anyone.
That's probably best. Yes, I would agree with you 1000%. Thank you, Michael. That was a great way to finish. Jim, thank you so much for being here today and helping back up the getting us some other answers to the questions. And guys,
by the way, Harry Mechanic agreed with me. He said you could even shoot somebody and you're not going to lose your license. Yeah.
Okay, Harry's retired. Are we listening to him? Harry?
Yeah, he's got lots of experience in this industry.
Oh my God, he definitely does. All right. With all that, guys, have a great week. Thank you, Michael. Thank you, Jim. Have a wonderful week and go get some loans. Close them.
Thanks, everyone.